So, how does this actually work? Let's look at a scenario where there's a central bank, which is currently identical to our reserve bank, which means all its notes and checking accounts are currently backed by gold. There is a commercial bank that has a checking account with the central bank and some reserve notes as reserves. Using fractional reserve banking, it has issued checking accounts to extend its balance sheet by approximately 900%, which means it has a reserve ratio of 10%. Finally, there's a person or an institution that trades in the bond market, for example the US Treasury bonds market, and currently owns a bond of that market which it wants to sell. Now, typically buying and selling does not change the money supply, because through a transaction, money is simply moved from one person to another. But in case of the central bank, this is not true, because the central bank can actually create money. That is, just like the goldsmiths, it can create additional banknotes, even though it does not have the gold to back them up. And this is exactly what it does. It prints up new reserve notes and then uses these reserve notes to buy the bond of the bond market participant. It thus increases the base money supply by the purchasing value of the bond. Now, sooner or later, this newly created money will usually find its way to a commercial bank. Either the market participant deposits it there himself, or he buys some good or service for it, and after a series of transactions, someone will not want to spend the money right away, and then deposit it in his or her bank account. Now that the commercial bank has received this new amount of base money, it uses fractional reserve banking to create even more book money by creating loans backed only by a fraction of base money. So, for every unit of base money the central bank spends into the economy, the base money supply grows by just that amount. But the amount of perceived money can grow a lot more, 10 times more if there is a minimum reserve ratio of 10%. To reduce the money supply, one simply inverts the process. This means the central bank sells one of its previously bought bonds in the open market. It thus receives a certain amount of money that was previously part of the reserves in the commercial banking system. Now, commercial banks are overextended and have to reduce their balance sheet by up to 10 times of the purchasing price to meet their minimum reserve requirements again. Using this method, the central bank can increase or decrease the money supply until the interest rate for new loans reaches its target rate. It can also support various entities by buying specifically their bonds, thus creating additional demand, and thus lowering the entity's borrowing rates. So, as you might imagine, a central bank is a very powerful institution. Its monetary policy can strangle the economy by making money very scarce and thus making interest rates skyrocket. Or it can give the economy at least a temporary kick by making money plentiful and thus allowing for an avalanche of new projects. But using fractional reserve banking itself, the central bank also becomes a lot more fragile than the previously described reserve bank, because similar to a goldsmith, it now issues more notes than it can actually back with gold. Furthermore, the central bank can now become insolvent. After all, it carries debt on its balance sheet, and the bondholders might default. Finally, there is still the problem of how to deal with insolvent commercial banks. So perhaps now it is the right time to take a step back and include the role of the state in our considerations. The way I described money so far, it has been a purely private matter, and the actual good that was being used as money emerged through the convergence of people's choices, in our example gold. And while it really was a lot like that in the past, nowadays the state no longer taxes its people by taking a portion of the actual goods produced, but rather demands payment in the state-mandated currency. So people are no longer free to choose as money or currency what they like, but the state mandates the form of money to be used in all transactions. Who creates that state-mandated currency? A central bank, of course. A central bank like the Federal Reserve, or Fed in short, in the United States, or the European Central Bank, ECB in short, in Europe. So, while a central bank is structured a lot like a private reserve bank, the state has a much stronger involvement. It often appoints the majority of the directors that serve in the executive board. There are typically special rules and regulations concerning only the central bank, and often the states own their central banks directly. Profits of the central bank are almost completely returned to the state, even if the central bank is privately owned, as it is the case with the Fed in the US. On the other hand, central banks often also enjoy a certain amount of independence from the current government, somewhat similar to the judicial branch. And while profits of the central bank have to be returned to the treasury, the knife cuts both ways, meaning the state is liable for any losses the central bank might incur, and any obligations the central bank is unable to fulfill. With the state entering the picture, the ascent of paper money reaches its final stage. Since the state is now liable for the backing of the currency, it soon starts to tamper with it. Often in times of war, the government needs more money for military spending than it can raise through taxes. It therefore issues additional bonds, which are in turn bought by the central bank for newly created currency. This is the dark side of the elastic money supply. It can be used to finance wars that would otherwise be far too expensive to pay by normal means. Of course, what then happens is that there are a lot more reserve notes in circulation than actual gold backing them. So, after too many holders of the currency, either foreign or domestic, try to convert their notes back into gold, the state stops the convertibility of reserve notes completely. And at that exact moment, fiat money is born. Fiat is Latin for "let it be done." Fiat money has to be used by law, that is, simply because the state says so. It is not backed by anything, and it cannot be exchanged for anything but currency of a different denomination. So, the value of 1 unit of fiat money is literally what you can buy for it, however much or little that might be. This is the kind of money we carry around in our wallets these days. Of course, the transition from paper money backed by some good, often gold or silver, to fiat currency happened with a lot more back and forth than I make it sound. But the final nail in the coffin of backed paper money was President Richard Nixon's slamming of the gold window in 1971. At that time, almost all currencies used US dollars as backing, while the US dollar was in turn backed by gold. This system was known as the Bretton Woods system, and under that system, exchange rates between currencies were fixed based on the amount of dollars, and therefore per proxy the amount of gold one could get for 1 unit of currency. But after France had been decreasing the gold reserves of the United States for a while by converting US dollars, which it had acquired through foreign trade, back into gold, Nixon finally got rid of the last remnants of the gold standard, and stopped the convertibility of the US dollar into gold. So practically overnight, pretty much the entire world found itself using fiat money. So, in a very real sense, the money we use today, and which we take for granted, has only existed in its current form for about 40 years now. But let's return to our discussion of the banking system for a little while longer. Now that we have a central bank that regulates reserve requirements, let's put ourselves in the shoes of a commercial bank that wants or has to raise additional reserves, and see how it could do that and what interest rates it would have to pay for the new money. Perhaps the most obvious way is to borrow the money from another commercial bank that has excess reserves. After all, that was one of the reasons why a reserve bank was introduced in the first place, to make such loans as simple as possible. So Bank B lends some reserves to Bank A, typically overnight, so that Bank A can satisfy the minimum reserve ratio. Bank A in turn pays Bank B the primary interest rate on the loan. Examples of such primary interest rates are the federal funds rate in the United States, or the LIBOR, which stands for London Interbank Offered Rate. If for some reason no commercial bank is willing to lend to Bank A, it can use the so-called discount window of its central bank. This is also known as the lender of last resort function of the central bank. To get additional reserves, Bank A sells some assets to the central bank, usually high-quality bonds, and pledges to buy them back later and for a higher price. So, it is somewhat like a secured loan, with the bond being the collateral. This is called a repurchase agreement, repo agreement in short. The higher price that Bank A has to pay when buying back the asset is set by the central bank. It is the original price plus the discount rate, adjusted for the duration of the agreement. Therefore, the discount rate is also sometimes called the repo rate. Of course, the third way for a commercial bank to get additional reserves is to attract more deposits by normal customers, perhaps by increasing its deposit rate, that is, the interest rate it pays on funds deposited with it. So, let's review the properties of the central bank, its influence on the money supply and commercial banks, and hence the economy. Perhaps the shortest way to describe the central bank is to call it the bank of banks. Just like normal customers with the commercial bank, commercial banks themselves have a checking account with the central bank and can draw actual cash from this account. And just like normal customers, commercial banks can write checks to each other using their checking accounts with the central bank. But while a commercial bank has to have at least a fraction of the money it lends out, the central bank has no such limitation, since it can create new base money arbitrarily. Whenever it purchases some interest-bearing asset, it increases the money supply, and conversely, whenever it sells one of those assets again, it takes that base money out of circulation again. Additionally, the central bank can set the discount rate at will. That is, the rate that commercial banks have to pay when borrowing money from the central bank via repurchase agreements. So, and this is a very important observation, by manipulating the money supply and setting the discount rate, the central bank in essence controls the interest rates that commercial banks have to pay for their reserves. This in turn determines the interest rates that customers and entrepreneurs have to pay, which finally strongly influence economic growth as we discussed when looking at the effects of an elastic money supply. Finally, let's turn to the last missing piece of the puzzle to complete our picture of modern banking: deposit insurance. After everything we have discussed, and even with the introduction of fiat money, commercial banks still have the same problem they always had. They use fractional reserve banking, thus making themselves vulnerable to a bank run. Now, while a bank is healthy, it has all kinds of means to borrow additional reserves to satisfy depositors' claims. But what if a commercial bank has become insolvent, perhaps due to bad loans it had extended, and it has no assets it can sell to the central bank through a repurchase agreement? It would have to go into bankruptcy, thus causing a shock to the system. Depositors at other banks might get weary of keeping their money at their bank, and a bank run might still ensue. To protect from such an event, deposit insurance was invented. As the name suggests, deposit insurance insures the depositor against losses, usually up to a certain maximum, in the event that the bank holding his deposit goes bankrupt. While it is the depositor who benefits should the bank go under, it is the bank that is actually buying the insurance. The bank benefits from it by being able to claim that, even in the event of its bankruptcy, its depositors will still be able to get their money back, which of course reassures potential depositors, making the bank more desirable for savers as a whole. To increase people's trust in this insurance even further, it is typically backed by the state, similar to the central bank. It is an obligation of the government, so that even during severe circumstances, for example, many banks going bankrupt at once, people will still not lose faith in the banking system and start a run on the banks. There are still at least two problems with this approach though. For one, depositors can now simply flock to the bank that pays the highest interest rates on deposits, even if the bank is making very speculative loans. After all, as long as the bank does well, they will continue to receive their interest, and should the bank go under, they will be made whole by the insurer, or, in the worst case, by the state itself. On the other hand, for the people in charge of this insurance, it is very difficult to objectively measure the risk that is being taken on by a bank. So, it is very likely that commercial banks with similar total deposits will have to pay roughly similar amounts for the insurance, independent of the actual risk that they are taking on. This phenomenon, where a person or institution can pocket any gains but socialize losses, is often called moral hazard, because it incentivizes reckless behavior, using a kind of heads I win, tails you lose mentality. The second problem is that, while depositors are safe, at least up to a certain amount, other creditors to the bank do not enjoy such a privilege. So while depositors might not lose their savings if a bank goes under, other banks and other creditors might lose a lot of money anyway, and in turn go bankrupt, causing yet more bankruptcies for their creditors, and so on. This is called systemic risk, and if we recall that the average leverage of a European bank is 25-1 now, this is potentially a very explosive situation. Nevertheless, with deposit insurance in place, there are now sufficient mechanisms to prevent small shocks from turning into panics and in the process toppling the entire system.